the next 20 minutes is that we're going to look at stocks that are really beaten down and they have the greatest potential to rebound after the COVID-19. And we are also looking at the same time, we're looking at stable income that have stable revenue. Hopefully that will have some potential growth in the yield as well. And most importantly is under value. The reason why we should look at all these stocks is because we know that the COVID-19 is not going to be here forever. At some point of time, they're going to have some new medical discovery and the disease could be cured and contained. And then COVID-19 is eventually will become nothing just like a normal flu. We have seen that in the 2003 SARS. And so right now it's just another period of uncertainty that we have to go through, but eventually it will go. So before I go on to talk about those stocks, there's a disclaimer over here. The presentation here tonight is only for education purpose only. You are responsible for your own investment decisions, and we will not be liable for any loss or damages if you decide to use this information tonight over here. And if you do not accept this responsibility, you should not be using this information. And if you are in doubt, please consult a professional financial advisor. So this is a disclaimer. To move on is that the company that we are looking at, or rather the companies that we should be looking at, should be at the north. In other words, North Asia. Reason why is that North Asia companies right now, they are being beaten down more than Singapore. In fact, most Hong Kong companies are right now trading either at their fair value or undervalue. So the three stocks that I'm going to talk later is all has North Asia's activities rather than just Singapore. The first stocks that I'm going to look at is, or the first company that I'm going to look at is Bank of China, code name 3988 if you're looking on the screen. It is the fourth largest bank in China, which is backed by PBOC. In 2018, the profit has increased by 7.5 billion, which is equivalent to about 4% increase. The return of the total assets is 0.94, not really great, but still is a positive sign. And it has a return on equity of about 12.06. So Bank of China, I think everybody knows about Bank of China. Just let me just roughly describe what is their business. So other than the consumer business, which is their domestic market, Bank of China are mainly in the commercial banking, mainly in the domestic commercial banking for that purpose. And during this COVID-19 period, obviously that shares, Bank of China shares has been beaten down, but not forgetting that the China government is letting go approximately about 1 trillion renminbi to help the local domestic enterprise, especially in the manufacturing. As I was reading, listening to the 6:30 news just now, a little bit while earlier, Chinese government right now are actually encouraging people to go back to work, and some of the provinces are now being relaxed, meaning to say that they are holding they're no longer holding the people and quarantine them. They sort of like encourage them to go back to their work to start off their manufacturing. So so the way I look at it is that the Chinese government is now coming in to help enterprises, manufacturers, factories, and all these things to back their business. And through this, the Bank of China is going to benefit out of this. Now let's look at some of the numbers, the fundamental numbers. right now, as today closing, Bank of China, the price to book ratio is 0.498. Typically for Bank of China, the PB ratio is between 0.47 to 0.5354. It rarely goes to 1. I know that a lot of us, we are talking about DBS is equals to 1.1 or 1.2, but for a bank in China, the typical PB ratios should be around 0.5253. So now, right now, it's fall below 0.5. To me, it is actually present a value by itself. The yield right now is 6.71%. Earning per share is 0.6718, which is basically consistent over the year. So if I would go back to looking at EPS in the 2015, 2016, 17, 18, 19, the EPS is pretty much consistent in what they are. So that actually makes me, confidence, in Bank of China in that manners. The net interest income, which is basically an indicator to measure how banks perform over a period of time, that remains consistent as well over the years, between 2016 to all the way to 2019. So that's basically how we look at it. So on technical side of it, sorry, I think I should all the way up. On the technical side of it, the Bank of China, you can look on the screen, is that right now it is sitting at closing today is at $3.11 over here. I'm not too sure if you see my cursor. Yeah, here's my cursor. So it's at approximately about 3.10, 3.11. That's today's closing right here. And it is coming into what I'll call a level whereby it is becoming very, very attractive. Knowing that Bank of China, the share price was actually down at 2.95 in September last year, when the trade war was sort of like at the most severe, between US and China during this period of time. And then subsequently, after that has been cleared, the price sort of like went up all the way to $3.35, 36 cents, and now it's sort of like sitting at 3.11. So now at PB 0.49 and at a price of, let's say, $3.10 and below, it actually poses, to me, is actually a good opportunity to look at these stocks, to keep it as a long-term dividend growth, or rather as a dividend income stocks for this from Bank of China. Okay, so moving on, the next one that that's actually on my watch list is Fortune REITs 0778. Now, Fortune REITs used to be listed in SGX as well, but it was being delisted from Singapore Stock Exchange in October last year. But the stock will still remain listed in Hong Kong. Now, why would I pick a Fortune REITs is basically it has a portfolio of 16 retail property, and they focus on neighborhood malls. And if you want to make that comparison between Fortune REITs with Singapore type of REITs, they are pretty much closer to Fraser REITs, Fraser Commercial Trust, whereby Fraser, as you all may aware, most of their properties are basically neighborhood malls, White Sand, North Point. These are the malls that we're basically closer to bread and butter kind of malls, for everyday life. So Fortune REITs are basically into that category. They are focused on neighborhood malls. But what is different from now? So let me go a bit a little bit more to talk about fortune REITs in details. If you have been to Hong Kong, you all will understand that this is the kind of Hong Kong living environment. And in Cantonese, they call it Uk Chin. So meaning to say that they have actually, what they do is that they actually build a huge mall. And the malls are surrounded by just blocks and blocks of residential areas. And we are over here, we're looking about a few thousands instead of just a few hundreds compared to Singapore. And the mall itself actually serves all these resident area. And this pictures is actually showing the new territory, Tin Shui Wai, which is the second largest populations estate. Tin Shui Wai estate. We use it in Singapore terms. Estate, which basically serving a few thousands of residents over there. And further down, if you look at this, this is the kind of the portfolio map for fortune REITs. You look at it is that they are basically located in outside of the Hong Kong island, starting from Kowloon all the way to New Territory, and even to Lantau Island, Tai Yu Shan. This is where the airport located. And they are really big. They are really big. One of the largest portfolio within fortune REITs is this. Underneath this New Territory is called Plus U over here. If you see this clearly on the screen, it's Plus U. In Cantonese, it's called Ga U. Ga U is actually their new estates, and this new mall just undergo a AEI in 2018. And with that AEI, they basically able to increase the rental space and rental revisions for 2019. And going forward, within this Ga U, they are starting up a second phase of renovations within their office blocks, malls, sort of like to expand the whole entire ecosystems within the New Territory West, and it is huge. So this Ga U, this Plus U, is the second largest revenue income generator for fortune REITs, and going forward, it's going to even bring more value into this for fortune REITs. So we look at this is that historically, there are 16 years of sustainable growth with an occupancy of 96.9%, which is amazing. Like what I mentioned earlier on, Plus U is the drive revenue growth, is the revenue engine for that. And then the best part, this is really what I like to hear, is that the rental revision is 7.2%, meaning to say that each time when a tenant wants to renew their contract with the mall, they are expecting a 7.2% rise in rental. Now, it's not good for the tenants, it's not good for the shoppers, but for investor, definitely, we like to hear this kind of news. It's like, oh, we can charge more now. This is really good. So that's how I look at fortune REITs. The yield at fortune REITs right now at current price, it is at 6% yield, which is really, really fantastic. You almost can't find anything similar in Singapore right now, to be honest. Price to book ratio 0.5, obviously it is undervalued. And the part that I was trying to stress is that the gearing is only 20.5%, meaning to say that the REITs, fortune REITs has very, very little borrowing, very little borrowing. That means a lot of work that they're carrying right now is pretty much within their own funds, within their own organic growth. Low gearing also means another thing is that because in Singapore, if you remember the REITs, is that there's always a ceiling of 46%. Similar in Hong Kong, there's always a ceiling. I think it's about 46% as well. So when you're at 20%, 20.5%, there is a huge headroom for them to borrow money from the bank to even expand further if they need to. So that gives them a huge headroom, going forward as well. So this is, I would say, is really one of the best REITs that I personally like it very, very much. In terms of technical chart, here you look at it, is there are 3 lines over there. Today the closing is 8.55. It is really beaten down very, very bad. Now, if you look at it, is that mainly the sharp fall down. The sharp fall down from here is basically due to the period whereby the protesters start to do havoc to the Hong Kong economy. So you can see that it's really, really one straight line down all the way until September, approximately about September. And then it's sort of like going sideways, and then now there's this COVID-19 coming in. It's a pretty unlucky year for Hong Kong. The trade war does not hurt fortune REITs, but it is the protester actually hurt the Hong Kong REITs very, very much, and that's why there's a big fall. Looking at this COVID-19, once it's over, people is going to come back in, the crowds come back in, the foot traffic is going to come back. So I would see that there's a lot of potential going forward. So even if by looking at the technical chart, we are looking at pretty much like 2 years low now, and the upside is definitely greater than the downside, in my personal opinion on that. The last REITs I'm going to talk about is Mapletree, NACT. You all should be familiar by this REITs. It is listed in Singapore, but their assets are all overseas. Mainly 4 assets: Festive Walk in Hong Kong, Gateway in Beijing, Sandhill Plaza in Shanghai, and a Japan property which is located, can't remember where, but it was just recently acquired in November last year. So that's why there's no information NA at this point of time. Festive Walk remains the main generator contributions by the assets itself. As you can see underneath here is that Festive Walk actually contribute 56% of the total revenue, followed by Gateway in Beijing, and then Sandhill in Shanghai, Sandhill Plaza in Shanghai, and then 30% from Japan. So this is basically their assets, their portfolio of Mapletree and NACT. The yield right now at current price is 6.52%. with a gearing ratio of 36.9. My personal guideline is that it would be nice to have a REIT gearing below 36%. So this is really a little bit high. But again, looking at the yield, looking at the branding, which is the Mapletree, and the mix of portfolio, assets portfolio within, I would still think that Mapletree, NACT is still a pretty good investment for long term. Looking back to the chart, the TA chart, is that you can see that it is all the way if I have to draw one straight line up over here, it is basically still on an uptrend over a period of 5 years. The highest price it was in June last year, and it went all the way up to 150. That's where we were saying that, oh, REITs is really overpriced. But now price has sort of like come down quite a bit. Now, looking at this chart itself, it shares the same pattern as the fortune REITs from July onwards. Somehow or another, I can't get my cursor back on my screen. But okay, so coming back to, it's similar to fortune REITs, is that from July onward, because of the protester, it went all the way down. And then if you recall one of the incidents whereby protesters actually went into festive walk and burned down a big Christmas tree, shattered the whole entire mall. And the mall really had to shut down for almost 1.5 months and only reopened before Chinese New Year. Managed to catch some of the traffic back, but again, Hong Kong is being Hong Kong. We are pretty unlucky, I would say. Then with this COVID-19, the mall is now suffered again. Right now, the price is at 114, which is, in my opinion, it's sort of like crowded within this range, which basically that's where all the prices are being consolidated at this price range. Again, in my opinion, I feel that this is basically a good time to look at these REITs. 6.5% Mapletree branding in Hong Kong and in Beijing and in Shanghai offices and things like that. When the COVID-19 over, I will assume that, or rather I predict that the price is going to rebound back fairly fast, fairly aggressive back to the growth path. So basically that's all for my presentations tonight. And yeah, if you have any question, please put it down on the chat and I'm more than happy to answer them. Thank you. Thank you, Emin.
Okay, thank you. Thank you, Jimmy. So once again, if you have any questions, please key on the chat. Okay, so I will actually only consolidate all the questions and ask them at the end of the session so as to do a bit of time management just in case we get lost in time. So once again, any questions after the speaker, if you can just key on the chat. I think we have one question there already. So key in the questions, later I'll retract back and ask the question back to the respective speaker. Okay, now thank you, Jimmy, so much. So of course, now let's pass the mic over to Philip. Okay, and let's see what he has got to say with the current situation. So let me just find Philip. How come I cannot? Okay, let me just. Okay. Okay, Philip, it's all yours. Thank you.
Okay, thank you, Emin, and thank you, Jimmy. Let me just share my screen. Okay, I hope you guys and girls can see my screen. So today, I'm going to talk about the market from a TA perspective. And I title it "Time of Uncertainty, Love It." And there's a reason for that. So let's go. But before we do that, the usual disclaimer. So I think Jimmy has talked a whole bunch of it. I don't need to repeat it. So this is the sequence of how I'm going to go through my session tonight. Basically, I'm going to talk a little bit about how I look at the market, how I select stock. I'm going to talk a little bit, fast jog through on how, based on the way I'm looking at the market, how am I going to manage my portfolio. And then basically what are the tools I use, and I have then a watch list for all of us on this webinar. Okay, so basically I use a top-down approach in the way I do this, and I put down there US as the big brother because it's 60%, almost 60% of the global markets. And you know, it accounts for 60% of the global market. So it's very important for me as a trader to look at how the US market is doing. And if I'm looking at US stock, then I will go down from the country, then down to the sector, and then down to my US watch list, and then down to the individual stock that I'll analyze you know, one by one. But today we will take another approach. I have pre-select some of the stocks, so we will be looking at the US, looking at Singapore, and then we'll be looking at the watch list. So I've cut short a couple of steps in view of the time. Okay. So now let's look at the Dow Jones Industrial. You know, this is Dow Jones. If you look at this whole chart, I plot it all the way back to 2008, where we had that big dip. So and this is on a monthly chart. If I draw a nice channel, nice trend line, whatever we can call it, we can see that we are actually on a pretty decent uptrend. And every time it goes to this bottom, it kind of bounce back, and up to, and for 10 years it has been really trading below this midpoint, this midline, and then towards the mid Q3 of 2018, it starts to go to the other half. And at this moment in time, we are seeing a situation where this the prices has hit the upper channel line and is kind of reacting, and that's normal. So the technical term, or actually it's not really a technical term, it's actually a term that's quite commonly used, is the reversion to mean. So I expect that on a long-term chart basis, on a monthly chart basis, there will be some form of a reaction all the way down here, and that being the worst case. Yeah. Okay. And if I draw a parallel on the S&P, we are seeing the similar type of chart. If we go over to Nasdaq is displaying the same behavior. Okay. So in a lot of commentary, we always say that the technology composite and Nasdaq composite, Nasdaq is always more volatile. But actually, from this chart, you can see that they are actually behaving very similarly on a month-on-month basis. Okay, and if we look at STI, and we would know that STI has gone sideways for a long time, and that's why it's really not quite useful for me to draw this kind of channel because it's been going sideways. But if you look at it, we are actually kind of trying to get above the 3004 level quite convincingly, but we have always been stopped by whatever reasons. But as a TA person, I'm not really concerned with the reason. I'm only concerned with the price. So if you look at it where we are today, this chart was taken midway through our trading session today, so it's not quite updated. I think today we finished up a little bit more, if I'm not wrong, or maybe a little bit lower. I can't really remember. But if you look at it, we are kind of in an unsure state, and that's very reflective of the sentiment on the ground as well. And the level to look at, if we were to say, okay, so we don't know whether it's coming down or going up, but if it were to come down based on the sentiment today, what's the level we're looking at? Worst case scenario, I would say we're looking at the 2750. Let me point my cursor. The 2750 as the worst case scenario. So there's some room here for it to drop. Yeah. So based on that, my long-term view of the market is we are still in a bull. So as such, I will be looking for opportunity to buy. But am I going to buy tomorrow? Possibly not, because I know that moving ahead in terms of days, there will be, or maybe even weeks, there will be downside pressure. So how I formulate my portfolio? The way I formulate my portfolio is long-term. It's going to be very, well, not very bullish. It's still going to be bullish, but short-term, I'm going to have some headwinds. What I will do is I will take two positions in an arbitrary portfolio. I will take two positions on the long side and one position on the short side. Okay, so I will have two buy and one sell. And in Singapore context, how we sell is typically through instruments like CFD and all that, which and warrants, which I personally don't trade them because I don't believe in this product. But that's just for your information. Okay, so how do I then, now I know where the market is going, then how do I kind of help myself determine what I really should be doing? So I use two things. I use technical analysis. As you can see, I use a lot of chart. I draw a lot of channels. I use the Fibonacci. I use the Ichimoku cloud. I use patterns and stuff like that. So this forms the basis of how I look at the market. And the other thing I look at is fear and greed with some common sense. And what I mean by that. So as we trade or invest in the market, sometimes everything goes smoothly. Just like a few months ago, I think everybody in the chat group was very happy because they see their portfolio balloon. And that's where greed comes in. Let's buy more. I think nothing's going to happen. And then sometime unexpected things happen. COVID. And it's broken. And then, as of today, I definitely see a huge chunk of my paper profit being sucked down, right? But I think these, whether it is up or down, whether it's fear or greed, it's not important. The important thing is for us to know how we can turn these situations, these problems into opportunities. Okay. So now this sounds very, very nice to hear when I first hear it, but how do we use it? So I'm going to give you something that I personally use a lot, and that's the VIX volatility chart. Okay, so what you will notice is that when things are going well, volatility is low. And what I mean by low is all these prices, this reflects the prices. They will be showing about between 10 to 12 to maybe even 15. And then when things hit through the roof, you will see that they will hit through the 20 levels. And this is oftentimes when something unexpected happens. So what we want to know, or what we want to do, is that in between these two scenarios, we want to find opportunity. We want to find opportunity that we can tap on, and we can kind of use it to our advantage. So that brings me to the next thing, which is what I will put on my watch list. And the first stock I will look at is actually CSE Global. So let's go to the chart now. This again is this is really hot off the press. I think I took this at about 7:50 before I came onto this webinar. So again, if you look at the chart, this chart is a yearly chart, also a chart that's from about a year ago. It is slightly trending, not very much of an uptrend, but still it's going up. And what we are seeing is that this chart has gone all the way up to the upper channel line, reacting a little bit, came down towards the midpoint, and even broke it, but was kind of supported by the 200 days moving average before it bounced back up. And my suspicion is that based on the stochastic indicator right now that we're seeing, that it's going to come down further. And this is where I will be looking at opportunity, possibly in a matter of weeks for me to take a position. There are other tools that I use to kind of predict, how many days I should be counting, how many weeks I should be counting, but I'm not going to cover them here because that's somewhat advanced knowledge and really technical. So just for the purpose of this webinar, my view is that there will be somewhat downside, but we should be positioning ourselves around the 200 moving average area, look for a rebound, and maybe this is something that I will really be very interested in at that point. Okay. The next one I'm going to talk about is actually one of my favorite stock and possibly my favorite joint as well, Starbucks. Okay, so let's go and see the chart. Now, so the Starbucks chart has been very trendy for a long time. Since possibly mid of 2018, where it suffered a little bit of a reaction and then it just trends up for about a year or so. And then we're seeing the same kind of reaction that's happening in the middle of you know, in the middle of last year, which is kind of almost a 1-year trend, and then it starts reacting. With the, I think possibly a 5 to 6% drop over the last 2 sessions in the Nasdaq Composite. This obviously is also a situation where, you know, the stock follows as well. But whether it's you know, it follows or not, doesn't matter. Look at the price and we say, okay, based on this position, where am I? Based on the current position right now, where am I going to? What decision I'm going to make? So there are actually 2 ways to look at this stock. Starbucks is fundamentally a good stock. If I learn well from Yimin's classes, you know, and how to look at the stock fundamentally. So, but if I were to go in and buy today, okay, there's possibly going to be more downside. And how do I protect myself? So what I could do is actually, if I have no choice, I have to buy today. Well, I will just go take a position, okay, but I will protect myself through option trades. And this is a little bit more advanced for people. I know there's some folks on this call here that trade option as well. You understand what I mean. For those who do not understand, it's okay. You know, we will not cover in this webinar, but if there's an opportunity, you know, I can take that with you all separately. But what I would do is I will take a position buying the underlying equities, that means buying the stock itself, but then I will position myself to sell a spread at the 75 region, because this is where we are seeing some of the we are seeing at the 50% FIBO level, close to that, and this is possibly the place where it will hit some kind of support and react. So what I will do with this stock is, if I can't wait, I have to buy, then I will do that. But if I can wait, because I'm not trigger, you know, happy, then I will possibly wait for it to break through the 38.2% Fibonacci area, see whether it drops further or it rebounds. And if it drops further, I will then wait at the 50% and wait for the rebound. So at every level, I will wait for the rebound. Once I see some rebound, I will buy the stocks. At the same time, to protect myself, I will also sell, you know, a vertical spread just below the price I buy. Okay, so this is how I will trade this stock. So basically, that's what I have for tonight. So if there's any question related to this, I guess we have a Q&A later. Back to you, Evan. You mean you're on mute, I think.
Okay.
Okay, good.
Can you hear me already?
Yep.
Okay, great. Thank you so much, Philip. Oh, I see a lot of questions flying. So thank you, Jimmy, for start answering to them. So to make sure everyone get it, so you the chat I'm actually referring to is the Zoom chat now, but I think some really get excited. I start chatting on the WhatsApp chat. Okay, anyway, so try to keep the questions on the Zoom chat so that everyone can benefit. So of course, if you really can't wait, and I think Jimmy has been kind enough to start answering. Okay, please continue. So same thing, if you have any questions for Philip, I think there's 1 or 2 questions coming in already. Please key into the Zoom chat. So later I'll revisit the Zoom chat to answer all the questions that you may have. Okay, now it's my turn. Now it's my 20 minutes. I just want to share my views on the current situation and what are the 3 main counters I'll be looking at. Okay. Okay, so hope all can see my screen. So number 1, I just want to give the overall market outlook first. Okay, what I've done here is this. I did a few things. Number 1 is I compare the current COVID-19 situation with the SARS scenario, which happens, if you can actually see the dates here, actually SARS officially started 1st November 2002. And based on the chart, you can see that it end about July period. So of course, if you look at SARS, the actual main window is actually between April to June 2003. So in April, whereby you see the numbers start ramping up, then it sort of peak, and after that, after May, it actually came down. So the number I'm actually looking here is the number of cases. Okay, the blue bar is the number of cases. So what I'm seeing here is this: for SARS, started on 1st November. In April, it start run up. In May, it peak. Then after that, it after May peak, it slowly come off, and probably June it died off. So that's the profile number of cases for SARS. Now, what I'm trying to do here is this: I'm trying to overlap what happened with the number of cases versus stock market. So this is STI. So obviously, since November onwards, once the SARS is announced, the market start dropping. And what you are seeing here is this: the market sort of bottom in April-May period, and after May, the market start to rebound. Okay, so if you try to tie in with the number of cases, the bottoming actually is about when the number of cases peak. Also, this is at least the observation I have here. And once the number of cases start to drop, okay, the market actually react quite positively. Okay, so this is what happened to SARS. Now, let's take a look at the current COVID-19 situation right now. I actually got this information from Worldometer. I've been tracking it on a daily basis. So this is the daily number of new cases. Okay, so again, you can see I can say that the COVID-19 actually started off in late December. Then, of course, only about Jan, then you start having some official statistics, and the numbers start to climb up. Number of new cases. So now for global, by the way, this is global, not just China alone. So for global, it more or less seems that we are at the peak. At least this is what the number is showing. So ignore the number on the February 12th. So what happened was they actually changed the way it was being calculated. So that's why you have such a spike up. But what I'm seeing here is this: it seems that at least based on the numbers that we have, the numbers are actually peaking. Okay. So this is a chart of the number of deaths. This is the number of deaths that are clocked in so far for the COVID-19. So again, you can see that the number of daily deaths seems to have peaked, which means to say every day we have lesser and lesser death, which is of course a good news as the day goes by. Okay, so this seems to be what is happening right now with historical figure that we can have. Okay, once again, I'm trying to overlap that with the stock market. This is STI since the first day of 2020. So once again, once the COVID-19 news is out, of course, the market actually went for a drop. Okay, went for rebound. And of course, you can see that generally speaking is a downward trend. So the question, of course, is are we expecting a rebound to be soon? Or do we still expect a further drop? Okay, so before I answer that question, I actually pull out a few more information, few more data. Okay, so number one here is this. One thing we have to acknowledge is that, COVID-19, there's some difference between COVID-19 and the SARS. So a lot of analysts, politicians, experts has actually said that COVID-19 outbreak is expected to last longer than SARS. Okay, so this is something that a lot of people are saying. Of course, this is an article interviewing our Prime Minister. So he actually, I'm quite sure he's probably advised by his panel expert, COVID-19 is going to be longer than SARS. This is another article that I actually got, so it's quite recent, 21st Feb. Apparently, Xi Jinping, the president of China, actually don't think that the cases have peaked, and they still have room to grow, or basically, echoing what the PMD is saying, that probably it's going to take longer than SARS. So these are some of the news that I'm actually getting. Okay, one other news before I come out with my own prediction is this. I actually caught this news in Channel News Asia. So how much damage will COVID-19 inflict on China's economy? So as you can actually read the article, read the small paragraph here. So the worst case scenario is that the GDP growth for the first quarter will be lowered by a third or half. That means talking about 2 to 3 percentage points lower than first quarter of 2019. So my point here is this: even let's say, for example, the numbers is peak from today onwards, the number of cases is going to drop. The economy will still have to take some time to recover, because we are talking about quite heavy loss in the first quarter. It's not like, you know, today you have lesser numbers, tomorrow the economy will start to rebound. So this is what I'm actually gathering from this paragraph here. And one last thing I need to take note before I share how I formulate my prediction here is this. Okay, if you could just follow me through this paragraph. Basically, most analysts believe that there will be a rebound. So of course, eventually the rebound is going to come. Okay, so given that you have a lot of macro policies adjustment, and they believe that the rebound will be fast and furious, economic growth accelerate again in the second half of the year. And if you actually read this paragraph, what it's saying here is this: they are expecting the full year decline to be only about 0.5 or 1 percentage point compared to previous year. So this is still largely in line with China growth trend. So what they are actually saying here is this: from a longer term perspective, that means we look at one full year, the current decline is probably quite negligible. This is what I understand from this paragraph. Of course, if you read the article as a whole, that's what they're suggesting as well. Yes, there's going to be decline, but the word here is this: just that the demand is going to be delayed. It's not that demand is actually gone. So when the rebound is back, it's going to be fast and furious. Okay, so putting this article and this article together, what I'm hearing here is this: yes, the first quarter for the China economy, in fact, world economy, is going to be badly hit. But you take from the full year perspective, okay, eventually it's going to be rebound, and after that the rebound be fast and furious, and this is just going to be a small blip from a long-term perspective. So with all this information in mind, what I have done is actually give my prediction. So once again, this is my personal prediction. So remember the disclaimer when you say this. I actually come up with two scenarios. One scenario is this: that means from today onwards, situation continue to improve in terms of number of new cases. That means we have lesser and lesser new cases as the days goes by. And if this is what is happening, I'm expecting the market to move it this way. That means it's hovering around. I don't expect the rebound to be soon. Okay, again, because like I said, the damage for the economy has been done, and the damage is huge. You cannot expect the rebound to come in so quickly. But if let's say it's improving, we will expect, you know, slowly the market on upward trend. So this is one situation. Okay. So the other situation, which is a bit more pessimistic, we assume that, let's say, you know, there's an outbreak in a city outside of China, and of course leading to a global outbreak, and all hell broke loose, and I'm expecting this kind of profile. So the STI will drop, okay, way below the previous drop. So I think the previous drop was about 3,001, so I'm expecting even below 3,000. If it happens, then eventually I think even if this case, you know, up to probably end April, May, things will eventually be better. So if you focus on the positive news, you see that now that vaccine, if I'm not wrong, is quite close to human testing already. They're actually saying that probably in April they'll start doing human testing, and of course when the summer start to come, it is likely that the number of new cases will have to drop. So that's what actually happened to SARS. So once they approach summer or, you know, hotter seasons, the number of cases drop. So eventually you will increase. But if let's say there are more and more bad news, we're expecting the market, or at least I'm expecting the market to drop slightly further. Okay, if you really want to force me, which I think is more a likely scenario, okay, so personally I think this is more likely to happen. So I'm expecting STI to drop. I think today is about 3.1 plus. I believe. Let me just confirm the STI today. If I believe there's a good chance you even go below 3,000. That's what I'm actually thinking. That's a more probable case right now. Okay, now, so most important here is this prediction is one thing. What is the strategy for this period? So, of course, based on my belief, these are the three things I'm actually doing right now. Number one, I definitely don't think there's a need to rush in. Yes, things are cheaper as compared to 1-2 months ago, but don't need to rush in. So number two is, again, my favorite tagline, save your bullets, conserve your bullets. So make sure if, let's say, the worst case come, you have enough bullets to scoop up. And again, you may want to start shopping, but be a picky shopper. So just in case we actually have this scenario instead. So as I always like to share, you know, very hard to bottom fish, very hard to buy the bottom. You know, when everyone thinks that the world is going to end, usually, you know, the reverse will happen. So I think it also makes sense that if, let's say, you buy something now, it can, you know, yes, you may not catch the bottom, but you are still getting a good price. So this is the strategy I have for this period. Okay, so what are the three stocks I am actually looking at right now, or the three stocks that flag out is GocoLand, OCBC, and CDL Hospitality Trust. So how did I actually find out these three stocks? So what I did here is this. I went through the SGX stock screener, and these are just the indicators I put in. Let me just do a very quick demonstration. If I were to just go to SGX stock screener, okay. And this is what I do here. I just put in all the 4 criteria I mentioned, PE less than 20. Okay, I use market cap. Okay, so what happened here is this. Generally speaking, when blue chips are always more preferred. If you ask me, blue chips are stable. You know, they give dividends. They are likely to last longer, so they are always a more preferred counter. But usually blue chips are cheap. Usually blue chips are expensive because it's well sought after. So generally speaking, when the market drops, to me, it's a time for me to hunt for blue chip. Okay. And of course, when the market is high, that's where when blue chip are expensive, then I'll look for growth stock. So now we are looking at the situation that the market is low. Potentially, we have blue chip that are undervalued. So I'll be focusing on blue chip right now. And to flag it out, I click on market cap, and I'm looking for market cap more than 1 billion. Okay, let me just try to do this. Okay, about there, you know, it's very sensitive here. Okay, same thing, I'll go for those with you. Like I said, you know, this is a time whereby you buy stocks that give you yield. So if even you lose money on the capital, you have some consolation price on the yield. And one more filter I look at is a 4-week percentage price change. That means stocks that the price actually dropped because of the COVID-19 situation. Just 1 month ago, stocks price has dropped. So I just shift this to 0. That means price compared to past 1 month has actually dropped. So with that, I actually have 34 counters. Okay, if you can see how I actually pick up the few stocks, I actually sort by the 4 weeks percentage price change. So which has the greatest drop? So of course, looking down at the list, nothing really captured my attention. So one that captured attention my most is actually CDL Hospitality Trust. I'll explain later, not to worry. Okay, and if you follow down the list, the next one is actually GocoLand. Also, the rest of the companies, you know, they may be good, they may be potential. It's just that the business-wise, these two really stand out more for me: CDL Trust and GocoLand. Okay. At the same time, I want to look at the market cap. Market cap, I want to go for the biggest market cap. So I just tap here. Then obviously the banks actually got shown up. And OCBC, okay. So the banks is here. Okay. I'm not sure why OCBC is not here. Okay. okay, was actually there. So anyway, that's how I actually pick up OCBC. It's actually one of the highest market cap. Not sure why it's not here today. Also, play around with it. So like I said, you know, if you like some stock ideas, if you got money to buy, don't know what to buy, you know, these are some of the indicators you can play around with. Okay, now let me go back to my slides. Okay, GoCoLand. What actually attract me? So again, price to book 0.47. Actually, I did this exercise on 21st Feb. 0.47 obviously is actually very low. Now the thing here is this. Okay, just quick recap on book value. So basically, for book value, it's actually derived by asset minus liability. Okay, asset of the company minus the liability, and with a price to book of 0.47, which means to say now we are actually using 47 cents to buy $1 of their equity, or you can think of it as $1 of the assets, in that manner, just to help you visualize. So the most important thing here is this: is the asset really worth that kind of value or not? So what you do here is this: you must have the visual. So what are the assets of GoCoLand? We're talking about the GoCo Midtown. So this is somewhere near the Bugis area, okay, Rochor Road area. So they are actually building a GoCo Midtown down there, office building. GoCo Tower. So this is more or less completed. So as you can see, you have quite a bit of activities there. So when you try to visualize the assets, so do you think that they can be sold, they can be rented out, they can be really worth the kind of amount that is actually stated in the book? So that's what you're trying to do here, the assets. Of course, they have quite a bit of residential projects. So in the books will be either property under construction or property unsold. Okay, so in their book. So again, when you look at it, the question you have is, do you think that these properties can be sold or rented out? So personally, I'm actually quite positive. I think that the assets can indeed be monetized. You know, whatever stated in the books can indeed be turned into money for that matter. So I actually did a bit more digging. Like for example, the residential project they have, multi-modern Mayor Mansion, Midtown Bay. How do you actually read this? This is, by the way, is from URA. You can see that cumulative unit launched today is about 420. And cumulative units sold today is 377. So basically, what it says here is this: the project are actually still moving. Whatever being launched, it can be sold. Like Mayor mentioned, launched 40, sold 31. Yes, of course, there are 200 units, but whatever launched, it can be sold. Okay, so Midtown, okay, launched 50, 46 sold. Also, by the way, these are not cheap. So you can check out, these are the medium price, 2006. So this is my personal belief. Whatever assets that GoCoLand has, I believe it can be monetized. Maybe it will take slightly longer, but it doesn't matter. Okay, it doesn't change the fact that I'm actually still using 47 cents to buy $1. So that's more important. So once again, the question here is, do you think this can be sold or not? Also, of course, if you don't agree with me, you think that no, it cannot be sold, then of course this is company that you don't touch. But if you're like me, believe that eventually it can be sold, that means that $1 on the book eventually can turn to $1, real $1, then you're buying at 47 cents, you cannot get too wrong. Okay, so again, why I actually had this confidence, in fact, just today I saw this article. We all talk about, you know, prices, whatever people are worried. So Wing Tai, of course, this is Wing Tai, it's not GoCoLand. What we are saying here is this: Wing Tai actually sold 70% of the M condo that was actually being launched. So you can see that people are still, you know, still rich. They can still afford to buy properties. And by the way, the average per square foot for this project is about 2004, which is quite close is what GoCoLand is selling. Okay, so this is how I see GoCoLand, the first one. OCBC, the key attraction is that the price to book is 1.03. I'm quite sure by now you all know that, well, once for banks, price to book go below 1, I'll go gaga, and I'll definitely put my money in. I see potentially there's a good chance for the OCBC to have the price to book less than 1 in the current episode, especially if the worst case scenario were to come. Okay, So I did a bit of calculation. The book value is 10.7. So if it goes below 10.7, I'll think yes, I will definitely be quite poor when OCBC goes to this kind of value. And very interestingly, this is what happened. I actually pulled out the past 1 year chart. You can see that apparently I'm not the only one tracking the price to book value. Can you see every time it hits about book value or price to book is about 1, there will be support coming in. So this is at least what happened over the past 1 year. Okay. So I'll be looking at this value, and I believe there's a good chance for this value to come in. So that's for OCBC. Okay, next, the last stock I'll pay attention to is CDL Hospitality Trust. So why it actually caught my attention is because now the yield finally is above my fair yield. So it hasn't, it was below my fair yield for a long while. Finally, it has go above my fair yield. So obviously, one of the reasons why the price drop is because hotel industry is one of the worst hit in the current COVID-19 situation. So I'm quite sure a lot of investors is running away. But I believe, again, like what the two previous speakers has mentioned, this is going to be short term. After that, it's going to go back up. Okay. So you're still buying good assets now. Yes, the rental for the assets is going to be temporarily affected, but still buying good assets. You're buying a good price. Come on, dividend yield of 6%, you still not too bad. So I think it's still good time to enter. And again, you can see that this is a 5-year chart, not a 1-year 5-year chart. Currently, it's actually trading quite close to 5-year low. The 5-year low is about $1.46. So actually quite close to 5-year low. And I think it's a good price to go. So of course, again, am I going to buy tomorrow? Maybe not. Like I said, I'm still a bit bearish, but this is one counter I'll definitely pay quite a bit of attention to. Okay, good timing. I've actually done my part as well. So thank you so much. Now it's time to open to the floor for question and answer. Okay, so let me just turn on the mic for Philip and Jimmy. Yeah, give me 1 minute, and we can actually get the questions up. So Philip. Okay, Philip. Okay, Jimmy. Let me find Jimmy. Jimmy.
I'm done already.
Okay, that's great. Okay, now, okay, I know Jimmy has went through some questions. Okay, let me just pick up interesting one. Okay. Okay, so Jimmy, there's one question here. Why BOC the PB is based on 0.5 instead of 1?
PB is basically price to book ratio. The theory, the textbook theory is that if bank is basically full of money, so every value you can see on the book itself, it represent $sign. So so if PB equals to 1, it means $1. That's basically the textbook theory. But in other bank, which is other countries' bank, when they are not really strong in terms of their book, especially they have a non-performance loan, or they do not meet the Basel III, or the bank's activities has certain high risk, the market don't see PB equals to 1 as per 1. BOC traditionally, like I mentioned in the presentation earlier, is PB is in between 0.4849 to about the max of about 0.5354. That's basically as much as I remember from my memory. So if we go to look at a past historical data, and you look at the trend that this is how it was actually fluctuates, then I would not look at the absolute of PB equals to 1 equals as my reference point, because if I would do that, then you'll find that you basically have a lot of choice of banks, which is basically below PB equals to 1. So that will explain why BOC, I'll be very keen to look at PB equals to, PB below 0.5 as my reference point.
Okay. Oops. Okay. Okay. Thank you so much. So Jimmy, maybe I still keep it on you first. It seems as there's more than one person asking why BOC and not BOC Hong Kong.
I think I've answered that question. BOC
okay.
Hong Kong is in my watch list too, but I would still pick POC is because it is more liquid than BOC Hong Kong.
Okay, so maybe I'll give you a break for a while now. Philip, so there's someone asking Starbucks. So is Starbucks more like a trading stock, a value stock to you, or something you want to keep for your children, or is it something just like how you treat your girlfriend? Yeah. Oh, sorry, Philip, we can't hear you. Okay, let me unmute. Okay, sorry. Okay, sorry.
Yeah, sorry.
Okay.
So basically, Starbucks for me is actually one of my favorite stocks for trading. But that being said, I do hold the underlying as well since quite some time back. To me, Starbucks. Well, the reason why I got interested in Starbucks was, they suffer a reaction when they have a switch in management sometime back, a few years back. And I got it first as a trading stock, but then when I trade more and more, I realized that this is, I start reading about them. I realized that this is actually a pretty good company, and based on the fundamentals, I think so basically they have a good business model. They have very strong branding, and they are actually on the path to convert actually even tea drinker to coffee drinker. And so you can see that they are actually very, very aggressive in China in the recent years. So I guess that's boosting their financials as well. So I would say it's both for me. I hold the underlying stocks, but I do trade in and out of the stock as well.
Okay, thank you so much, Philip. Jimmy, back to you. It seems like you're getting very popular. A lot of people like to fire questions at you. There's actually one here. Gearing ratio for Mapletree North Asia is preferred to be 36.9. Wow, do you say 36.9? I think you said 36, right?
36.9. I say 36.9.
Oh, your preference is below 36.9.
My preference is below 36.
Preference below 36. So how do you actually get the magic number of 36? I think that's
there's no magic. It's just a preference, because the way I look at it is that, so the way I look at gearing ratio is this. I'm not too worried about they are not be able to repay the loan. I'm more interested whereby how much headroom for that particular REIT it has. Meaning to say that if the REITs will want to acquire new property, or the REITs required to do an AEI, then the lower the gearing ratio will means that there's a higher headroom. So it's like, for example, if I have $80 in the bank account versus I have only $20 in my bank account, what $80 will actually give me the buying power to do the things I like to do. Whereas the 20, I'm basically limited by choices. So for 36%, when I look at 36%, 36% to 45, right? It means, if I'm not wrong, 45 is basically a ceiling.
Currently, yes, correct. Yes, yeah.
Okay, 45. So we are talking about a very, very narrow margin. So assuming that if tomorrow the REITs will want to do an AEI, or they want to do acquisitions, what are they going to do? And most of the time is that, as you can see, REITs call for rights. Rights, although it is not necessarily a bad thing, but in general, it is also viewed as raising money from the public, or borrowing money from the bank, basically it is not what we call non-organic growth. And when we talk about non-organic growth, it is something that whereby is always a concern to me, in my opinion. So 36% is only my personal preference. If you want to pick something which is more conservative, like 32%, is perfectly fine as well. That's how I look at it.
Okay, thank you so much. Jimmy, just follow up another questions. There's actually one of how would you compare Fortune REIT with Link REIT? Probably you may want to talk from the property perspective. Do you see that the portfolio of Fortune REIT is a lot better than the one in Link REIT?
No, actually Link REITs is a different, completely different type of REITs. So let's start with something very simple first. I prefer Fortune REIT is because it gives good yields, and it has come down to the price actually come down to a level whereby it is what I would call fair value or maybe even undervalue. Link REITs is, in terms of quality, it is much better than Fortune. And because it is a much better quality, you can see that Link REITs, the yield is pretty low in my opinion. I think it's hovering around 4.7, can't even hit 5. Link REITs is also held very tightly by institution and funds manager. And if you go to any of the if you look at some of the funds from BlackRock or State Street's, major fund, you will always find Link REITs as one of their major components in the fund. So the funds are not selling Link REITs at all. Okay, so that's basically in terms of investment perspective. In terms of quality, in terms of REITs portfolio, Link REITs is not looking at malls. Link REITs are basically looking at, okay, I will use a Singapore context. Link REITs is like they go up there and buy shops like kopitiam in the neighborhood. It's like your Ang Mo Kio, your Bishan, your Marine Parade. Those kind of small little, very old shops, very run down. They go up there and buy, and then they redo it. They re-renovate it. They do an AEI, and they hype it up, and then they start to rent into really what we call quality tenants. It can be clinics, it can be local bank, it can be service, value-added service tenants and things like that. And they have been very, very successful to this because Link REITs are somehow or another being backed by the Hong Kong government. So if you've been to Hong Kong, you know that in Hong Kong, their buildings are generally very, very run down. You look at it, it's like, oh, how can it be Hong Kong? Some of these buildings are so run down. So the government actually encourage, private organizations like Link REITs go up there and buy up and scoop up all this property and to rebuild them and to hype them up and to give them a new lease of life. So that's basically what Link REITs is doing. And they've been very, very successful since they are launched, I think about 10 years ago. It's basically a one-line up. So let's explain a little about Link REITs. You can read more about it from the internet if you want to Google those information.
Okay, thank you. Okay, so maybe I'll give you a break. There's a question for me. What is your personal opinion on percentage if cash to hold in a current situation, and how would you expect it to be deployed according to your prediction? Okay, so I'm assuming now that all of us already have invested something. So personally, whatever I invested, I don't think it's the best time to sell. Based on what Philip Jimmy has mentioned, and also based on my personal belief, I think this current downtrend is going to be temporary. So I'm definitely not going to sell anything. It's more to buy more. So if let's say, for example, this month, assuming that let's say I have $5,000 for investment, probably I only want to put in like 20-30%. Okay. Into the market. So let's say next month, okay, let's say again I have another 5,000, probably I'll go into maybe 50-60%. Okay, and I'm actually going to track the what you call that, the number of new cases more as a benchmark. Okay, so now of course the everything is focused now on the Korea and Japan. So if let's say that can be contained, good news start to come, then probably I'll buy a bit faster. Okay, with the money come in, maybe buy faster. But if let's say we are in a situation whereby we are talking about the worst case of the global pandemic, like for example, I was watching Lawrence Wong's YouTube video, which they did a press release yesterday. They said that the worst case is we just have to live with it. It's going to be there. We just have to live with it. So then, of course, the market bottom probably going to expect a bit later, maybe April, so on and so forth. So my point is, I'll use the number to track. But what I can tell is now if let's say I have 5,000 maximum, I only put 1,000 into the stock market. So hopefully that will give you a sense of how much I've deployed. Okay. Another question for me: how would you compare UOB DBS versus OCBC right now? So at this point in time, I think the three banks, in terms of the quality, is it's not a lot different. It's not a lot different. Of course, DBS has known to be a more what do you call it? A more growing bank. Okay, they actually focus a lot more on growth. They actually have more initiatives. If not, you talk in terms of their asset, their quality is about the same. So I will actually focus a lot more on price to book value. Okay, and among the three, now OCBC is the one that is actually closest to below 1. So that's why I actually focus on OCBC. Of course, if let's say your budget is not an issue, probably it may be good to buy all three as well, since all three has came down. Just like OCBC is just a clearer point for me. Okay, maybe I just throw the mic back to Jimmy. Let me take a break. Okay, questions to Jimmy. What is your viewpoint on the idea people said that Beijing will try to replace Hong Kong financial position to Shanghai or Shenzhen, or does it not affect our valuation for Hong Kong REITs that you have just shared?
This is a question that is actually beyond my pay grade. So
you mean you're paid?
Okay. First of all, I'm not Xi Jinping. I don't grow in that environment. I won't be able to comment anything that is that China going to do to Hong Kong. I think that's a very unfair kind of situation that, or rather, anything that comes from me is just only purely BS. So so I will let this question as it is. I'm not be able to answer those questions. In terms of the hey, even I am seeing black screen here. I'm not sure.
Oh, so sorry. Okay, yeah.
Yeah. So so I'm not sure what are the Beijing decisions going to affect Hong Kong stock market and things like that. First of all, I don't think Hong Kong is going to be replaced by Shanghai market anytime sooner. Mainly because of the monetary policy that has been put in place, the infrastructures, the legal systems, and all these things. Hong Kong traditionally are still very, very connected to the world economy, the monetary systems, and compliance, to what the World Bank will, that impose. So, so if there's any speculations in terms of, how Hong Kong stock market is going to become, if it will come, it will come, but definitely not something that within my foreseeable future, in my opinion.
Okay, thank you, Jimmy. Okay, Philip, now your turn. I have this question here. For Philip, can you share your technical views on Roku and Tesla? Feel free to take over the screen if you want to.
Okay. Yeah, I think I may need the chart.
Okay, so I'll give you the host. Okay. Now you have the screen, yeah.
I have the screen. Let me just share this. Okay. Can you guys see the chart? This is a Tesla chart. So basically, Tesla has had a very phenomenal rise from this point all the way up here. And basically what it means is that if you look at the 200-day over moving average, it's already totally overstretched. And all I can imagine is this stock will pull back. This is more like the irrational exuberance coined by Alan Greenspan. If you look at the chart, if you look at the indicator, it will tell you that this is really going to be charging forward more and more. But if we use some source, so this is greed, right? But if we use some kind of common sense, then I think we could expect some more reaction. Possibly, I would say break through this level down to the 38.2 level before we see something that's stabilizing. So that's for Tesla. For Roku, it's also another pretty phenomenal stock. So
Okay.
can you all still hear me?
Okay.
Okay.
Yeah. Okay.
So if you look at Roku is interesting. I think it's a bit messy right now. Let me just close off one of the indicator, which is useless in this case. So where it is right now, this is a little bit different story compared to Tesla. It has actually reacted at this point. Tesla is more of, at this point right now, but this Roku is, has already broken its 20-day moving average. I think it's going to test the 50% Fibonacci level, possibly rebound, test the 200-day moving average around this level before it goes further down. For Roku, I think it's a short trade. In fact, it is actually a pretty lucrative short trade. Even if you short, even if I go into the market and short today, I think because it's on leverage, I think there's still some meat to go, coffee money. But I think to buy, basically, I will not look at buying unless it comes down to possibly this area, this blue area here. This will be the buy zone. Yeah, so that's my take on this too.
Okay, thank you. Let me just get the mic back. Okay, just make sure I'm on. Okay, great. So just a question for me. Okay, let me answer this question first. There's a few questions for me. CDL Hospitality Trust dividend yield is 4.6% on StockFacts. Do you get the yield from here? No. Also, Ascot Trust a yield of 5.6%, according to software, almost 3 times market cap. CDL is Ascot a better pick. Okay, unfortunately, StockFacts, somehow the dividend yield in StockFacts is not as accurate. I actually get the yield number from reitdata.com, reitdata.com. Okay, so the numbers at reitdata.com is actually more accurate. I actually have verified most of the numbers with the actual dividend yield when I calculate using the numbers my annual report. So I have already feedback to StockFacts. Okay, so please take note for the yield, we should actually look at reitdata.com at least for now. Then okay, so between Ascot, so like I said, for REITs, I just compared my fair yield. So so for Ascot, the current yield is still below the fair yield. So probably what is more interesting to me is CDL. So once again, today there's actually a lot of stocks that's actually quite interesting. So if you could recall how I pick up this stock, is just based on the investment idea that I used using the stock screener just now, that 4 filters. So are they the best stock? I'm not too sure. Okay, it's just that these are the 3 stocks that are interesting to me right now. Of course, obviously there's tons of others which also can be quite interesting. Okay. there's a question that asks which sector is going to rebound best during the SARS and which sector is the same. So unfortunately, I actually didn't really look at which sector which is going to rebound first, but even currently today, you realize that all the healthcare counters have not really go down, have not really went down. I think thanks to some of the information I got from your earlier, like counters like Riverstone, like Top Gloves, if you talk even like Raffles Medical, they didn't really come down very much. Okay, so as to which one will rebound first, I'm afraid I actually didn't do that study. Okay, maybe we just take 2 more questions, then we call it a day. Because it's about 9 o'clock already. So of course, if there's any questions, we can continue on the chat. So let me just take 1 more question. Then after that, I'll pass Philip to take 1 last question. Okay, so a question for me, how would you compare Hong Leong Finance and with OCBC, given that PB for Hong Leong Finance lower and better dividend yield? So once again, like I said, both may be good stocks, but for Hong Leong Finance, all the time their PB is below 1. They have been PB below 1 for the longest time. So nothing exciting. So if let's say OCBC can get PB below 1, it's actually something new, something more interesting. That's how I see it. So, but then again, if you ask me, both are actually very good counters. Probably, if budget is not a concern, it's time to pick up even for both of them. Okay, now, Philip, I need you to answer 1 last question. Let me see where's the question. Okay, here is it. How do you see Dow Jones drop impacting STI and China Exchange? Philip?
China Exchange. So I think yes, it is Shanghai Composite, right?
Yeah.
Let me share my chart again. So
Okay,
Singapore.
Let me pass to you.
No issue, no issue. I can just share the chart.
Oh, you can share from here. Okay, great.
Yeah. But let me click it down first. Okay, so can you see?
Yes, I can.
Okay, so just a quick one. This is, the candlesticks is STI. You compare this with Dow Jones, which is in orange, and then Shanghai Composite, which is in this light blue. You can see that since a while ago, Dow Jones and Shanghai Composite has actually decoupled. So after the big spike to 5,000, I think it just basically went all the way down, and it's still gyrating. But I think China is fundamentally, the stock exchange is, the stock market is going through some fundamental change right now. I believe there's some stabilizing mechanism in place. My take is midterm. Short term, probably it will still be very choppy. Midterm wise, I think we will start to see it rebound. Then there is a possible, switch in terms of US and China. But it's anybody's guess how that will turn out. As for Dow Jones impact on STI, it's almost no impact. Whether Dow Jones go up, go down, STI is going to continue gyrating. It's going to continue go sideways. But if we have a something that's really, really hard landing in either China or US, I think that will affect us pretty negatively, because we are a small market compared to US and China. Yep, that's my point.
Okay, thank you so much.